Good morning and good afternoon, everyone. It is October 2nd, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you are a member of the press, please log off and reach out separately. Please also note that this webcast recordings may be recorded. Today we have Chetan Iyer, Chief Asia Economist, Jonathan Garner, Chief Asian Emerging Markets Strategist, Rajiv Sabal, Senior Global Economist, Zhipeng Cai, China Economist. During this podcast, you can send us questions at any time from the Ask a Question text box. Recently, there has been a lot of debate over whether tariffs impact are ultimately going to hit the economy, and so far we are still seeing mixed signals. Today, we have Rajiv to share the observations globally on the economic activities in different regions, and then he will also share his thoughts on whether the worst is over. Over to you, Rajiv.
Hey, good morning, good afternoon, everyone. It's morning where I am. I'm going to quickly share my screen, and hopefully it catches onto the main video conference. But the main thing I want to talk about is some of the micro data that we're seeing in the United States. We've written about this pretty extensively. While the headline data in the United States appears to be strong or not impacted by tariffs, what we're seeing in the micro data is pretty clear indications that tariffs are distorting certain subsegments of the U.S. economy, even if it's not hitting the headlines. And our general hypothesis is that micro data is a lead indicator or a foreshadow of what might be happening in Q4. We have to go back and remember that many of the macro community hypotheses around the impact of tariffs were centered around September, when tariffs were first introduced in March, April. And the reason for that is because statistically and for practical reasons, the usual time lag between the implementation of tariffs and the effect on macro data is about 4 months. If you think about it from a practical standpoint, it takes on average 45 days for a good that leaves Asia to ship to the United States. And then you have another few days or weeks in transit in the United States, either at the port or in domestic supply chains. And then you have to add in a little bit of an inventory cycle. And for that reason, in historical episodes of tariffs, we've seen that the transmission effect is about 4 months. Since tariffs were not really implemented in April and they were scattered throughout the summer, and the full effect of Asian tariffs really came in August, our hypothesis is that the transmission mechanism was spread out and delayed into the US data. And so what we've been doing is spending time trying to figure out if that is true and test that case. And the chart I have in front of you is from a note that we wrote in September that looked at the mark-to-market of tariffs. For those of you that may not recall, Morgan Stanley Research and the global economics team have built a database that attempts to track at a global level all traded goods in the world. And we've been able to map tariffs on top of that. And what we do in this chart here is we do a breakdown of tariffs by sector versus the inflation effect as measured in the United States between the months of April and August, which was the last day we had data as of the publication. And what you'll see is that there's a standard regression line, which is what you would expect. Higher the tariff, more inflation. But there are some important outliers that I wanted to highlight. Most notably for Asia is the kind of video equipment, info processing equipment, media, clothing, footwear, luggage, which is textiles, and then new motor vehicles. These are 3 subcategories that have not seen inflation to the same effect of the level of tariff as you would expect. The new motor vehicles has its own nuanced story, and luggage and other categories have their own nuanced story. But in other work that we've done, looking at electronics, textiles, what we've seen is that there's been a lot of transshipment going on in Asia. We've seen goods shift market share in terms of imports to the United States by up to 20 to 30% in a matter of 3 or 4 months, which suggests that that's more transshipment than a shift of production. And the implication there is that after August, that transshipment becomes more and more difficult. And so we might start to see more impact in some of these subcategories later in the year. Motor vehicles has its own nuanced story, which I won't get into in this call, but overall to say that we see in the inflation data that transshipment seems to have been one of the reasons that you have not had as big of an effect in U.S. Inflation as you might have expected. I think the other thing worth noting is that in the recent US GDP data, we've seen other signals around tariff impacts as well. If you look at Exhibit 5, and I'll try and blow it up here a little bit in our note, you'll see that the unit non-labor cost has increased pretty dramatically in the second quarter of 2025. This is based on US profit data. And that unit non-labor cost is hypothetically largely attributed to tariffs. And it's being paid for through a combination of unit labor costs and profits. So margin compression is the profit, and then unit labor costs, we think, is basically that companies are starting to lay off workers in reaction to the price pressures or the cost pressures that they're seeing in their supply chains. Very little of that, as you can see in the blue, has been transmitted to price pressures as of yet, which is why in the US economic data, you do not really see as much of the inflation pressure as you might expect. And I think the other thing worth noting is that some of these cost pressures seem to be more concentrated in SMEs rather than in publicly listed companies on the S&P 500, which makes a certain amount of sense because the large S&P 500 companies have a lot more supply chain power than do the smaller enterprises. So the point is that the smaller enterprises are feeling the cost of tariff. It's just not as obvious at the headline or in the S&P 500. And that unit labor cost, which is basically the way it seems that companies are starting to react to tariffs by laying off workers, is something that we think is a contributor to the decline in non-farm payrolls. We will not get a non-farm payroll this Friday, or so long as the government is shut down, we will not get a non-farm payroll. But you can see that in the recent ADP print, and we have to take the recent ADP print with a grain of salt. There were some revisions in the ADP print that may have exaggerated the decline yesterday. But overall, you can see that the trend since the beginning of 2025, even in the BLS non-farm payrolls, has been a declining trend. Some of that is tied to immigration trends in the United States, but some of it is tied to tariffs. How much is attributed to which is still something that will take time to discern. But the point being that we do believe that the payroll risks are more to the downside as a result of tariffs. And employment, profit data, these are just two of the many early signals that we think we're seeing on tariffs. Just to give you a bit of a preview on what Chetan may be speaking about, Chinese exports have remained subdued. We're starting to see that trend in the rest of Asia. And in fact, if you look at the European manufacturing PMIs, they started to roll over as well, particularly after those August trade negotiations started to formalize the tariffs on the euro area. If you look at the manufacturing PMI export sub-indicator in the euro area, it fell to 48 level, well below the headline, well below the output. And it's suggesting a lead indicator that we have more pain to come, so to speak, in euro area manufacturing exports. And so the point being that we see signals of tariff effects coming through in US data and global data, and we expect that to continue into Q4 since tariffs were really only implemented through the summer and deep into August. So maybe I'll stop there and hand it back to Crystal.
Thank you so much, Rajiv. So in Asia, we have seen the daily Korean export data that was down by quite a lot after the adjustments. And also beside trade, we have another issue in Asia as well on youth unemployment. Chetan has published a deep dive report on this as well. So let me invite him here to share his thoughts on the two issues.
Yeah, thanks, Crystal. So just first up on the trade data in Korea. So we've been, as you have been hearing from us on this forum for some time, that we will be watching two key high-frequency data points in Asia. Number one is trade, and number two is capital goods imports. Now, on the capital goods imports, we don't have the data point for the month of September for the broader region. But for trade, we always look at Korea for high frequency indicator of 10 days, 20 days, and 30 days daily exports. So as you would have seen it in the data, the headline exports numbers are fine. But because of the way the holidays have shifted around, we always adjust it for number of days. And when you do that, it is showing a contraction of around 6% in the month of September. So just to show you the chart here, so this is the chart that we look at on a 10-day, 20-day, and full month basis. And as you can see from this chart, all three lines. So I saw this first on 10 days, then I said, okay, let's wait. 20 days was also bad, and now the full month is also bad. So there is a clear indication of tariff impact finally flowing in through. And the reason for this lagged effect, as we have been mentioning, is the front loading of exports. And now there is a payback. And if you think of it, underlying, there has been a slowdown in the global economy, as Rajiv was mentioning. And so you're going to have a double payback. One is on account of the underlying slowdown. Second is because of the front loading that is going to be coming back to reflect in the numbers. So those are that's the update on the trade front. Now on the youth and employment. So what we try to do is to assess what's happening at the margin in the labor market in Asia. And what we are noticing is that there has been a weakness in the labor market across the region, but particularly on the three largest or three populous economies, which is China, India, and Indonesia. And what we are seeing is that this is a combination of structural factors as well as cyclical factors. On cyclical front, there has been some slowdown in the economies even before the trade effect has come through. You can see that in the China PMI data, but that's not just because of exports, but also because of the underlying domestic demand slowdown. India has also going through its own idiosyncratic domestic demand slowdown because of previous monetary and fiscal policy tightening. And Indonesia has, I would say, has been more weak because of the structural factors, because those have been sort of weak for a while, and they've just not seen that recovery that everybody else saw post-COVID. And so all the three economies in the region are seeing this challenge of overall unemployment rate rising on an underlying basis. And also we are seeing alternative matrices, like in case of China, labor market health indicator is showing a continuous weakening in the last few months. We are also seeing the entry-level workers' wages contracting in China, which is quite weak. And in India's case, there has been some improvement at the margin in terms of job creation. But if you look at wage growth trend, again, this is a bit of a proxy that we use for urban economy, which is from the quarterly earnings results of the corporate sector. So we kind of know the wage bill, not necessarily wage growth, but we use that wage bill growth as a proxy for overall labor income in the urban economy, and that has also been quite weak over the last 4 or 5 quarters. So we have this cyclical slowdown on top of and structural slowdown, and on top of it now going forward, you're going to see the damage from tariff, and from a structural perspective, you will see some pain from increased spending on AI and automation. So we are quite concerned about the youth unemployment situation. And if you think about the social stability events that occur, those tend to occur largely with the youth unemployment conditions. And that's the reason why we are zooming in on this parameter. And so we are sort of looking for policy actions from various governments, whether they are able to take the actions in a preemptive manner. In case of China, we are expecting fiscal expansion. In case of India, the government has already taken a number of policy actions, and we'll have to wait to see whether that bears on the growth recovery and therefore labor market recovery. And in Indonesia's case, we are still somewhat bearish on their outlook, because we don't think that the uncertainty that has been there for the corporate sector to take up investment has cleared or is probably going to clear anytime soon. So with that, let me pause here and hand it back to you, Crystal.
Thank you very much, Chetan. So given all of these economic backdrop, Asia EM multi-valuations are approaching bull case. So let me invite Jonathan here and who is with us today as well to share his thoughts on whether he thinks this is sustainable.
Thank you very much. Good morning to everybody. So I put up the executive summary here from a PowerPoint that we published this morning. And 48 hours ago, we published a note on the same topic. So in summary, these valuations we're now at are probably not sustainable without EPS growth reacceleration, which in turn requires economic reacceleration, which I guess Rajiv and Chetan just talked about the house view there. For sure, we have something of a reflation story in China, but it's slow. And India's growth rate does most likely inflect back up. But as my colleagues just said, the trade-sensitive economies in the region are clearly exhibiting the pressure from tariffs. Another big macro theme of ours is dollar weakening, and BOJ probably still hiking whilst the Fed cuts significantly. And this is an environment where you're going to get local currency strength, obviously, particularly in the case of the yen. So if you move on to our preferences, we still, and have been this way all year, prefer local currency earners. So financials, domestic e-commerce, consumer, industrials, including defense. We're broadly overweight global cyclicals, but particularly energy and materials, ex-gold. And we are selective in IT. We've been careful where we position in that overall thematic. So just on this valuation point that's central to the note, you can see here just how dramatic the recent re-rating has been. So our coverage markets, China, AXJ, EM, topics, they're basically back one standard deviation above 10-year averages. This sort of late cycle catch-up in valuations to the US has characterized the asset class many times before, and it's not to say that it couldn't go further. But it does set up fundamentally a dissonance with what's going on in the economies right now. And when we look at the earnings expectations, it's quite important to recognize here that there's nothing very different happening from our forecast December 26 outcome. So we're not changing our earnings forecasts here. So China's in red, EM is in blue, and Japan is in yellow. And so when we look at the deviations to bear, bull, and base being these sort of blue diamonds, we do have now approaching 10% downside to base case target, for example, for overall EM, and very minimal upside. In fact, for Asia X, we're pretty well at the bull case that we specified at the mid-year, and we were more constructive at the mid-year in May, but we've come a long way since then on valuations. So in terms of the focus list that we run, which we do feature in the note, we've been quite careful about our positioning in relation to sector, as you see here, but the overall thrust is domestic in nature with very few exceptions. We did put Samsung Electronics back in our focus list in July on the HBM thematic. So that was an important dipping of the toe back into the tech side of things. But in general, it's that domestic thematic. And when we look at performance, fortunately, we've managed to outperform a rising market. But again, on the left-hand side here, really should, I think, dwell on the fact as investors that this is not a normal market. And so the challenge on a go-forward basis with returns in the index of 40% in Asia ex-Japan since the second week of April is going to be to preserve capital longer term. So we may well have to be, investors may well have to be quite nimble on a go-forward basis. It's not quite so extreme in global EM, and I think one of the reasons for that is that the intensity of the excitement around tech and everything that goes with it is obviously more expressible in Asia ex-Japan and parts of Japan than it is in EM. I'm probably going to keep it quite brief. There's a lot more I could mention in the PowerPoint, but do check it out, and I'll hand it back to you, Crystal. Thank you.
All right, thank you so much, Jonathan. And last but not least, we are zooming into China, which has seen some targeted easing measures announced. We have Zhipeng here as well with us today to share the team's takeaways on this.
Thanks, Crystal. I'm sharing my screen here. So basically for China, our main conclusion is that number one, policy easing is underway to cushion the domestic demand slowdown in recent months. We think these incremental measures can cushion the growth downside, but inflation and inflation as well, but it will probably not deliver a durable reflation. And finally, we think that structural reforms are critical to a durable reflation, but we think that we can get the first glimpse into the structural reform initiatives at the October 4th plenum. So first, in terms of near-term growth and policy, we do see that growth is slowing down from a robust 5.3% in the first half, particularly as the fiscal impulse are fading. We know that the debt swap program, which is very helpful in terms of relieving local government financing pressures, is heavily front-loaded. Over 90% of the quota was already used in the first half. That's why we saw that basically in the fourth quarter last year and the first quarter this year, growth was very robust. But as this fiscal impulse gradually starts to fade from the second quarter onwards, growth is again facing some incremental, headwinds. That's the first headwinds. But number two, on this consumer goods trading program, we think it is also facing some uphill battle because a lot of the demand in these discretionary big-ticket items have been brought forward. But the multiplier effect of these, consumer goods trading program is relatively limited because of the job market remains quite weak. And finally, we also see that manufacturing investment is slowing sharply due to this anti-involution push. Because in the past 3 years, local governments, in coordination with a lot of local companies, are trying to invest a lot in these emerging sectors. So the previous incentives were about creating more capacity, creating more investment. But with this anti-involution initiative, I think the incentive partially reverses, and then we see a relatively big cliff in terms of manufacturing investment. It probably will be beneficial in the longer run, but in the near term, it's still a clear downward headwind for domestic demand. So even though exports in general hold up relatively well for China, but domestic demand is slowing more than we expected, and that's why we have been saying that maybe in the recent weeks, in late third quarter and early October, we are going to see some incremental policy easing, and it is exactly what happened. This week, with the NDRC formally announced that the so-called new infrastructure financing tool is being implemented. So the program is about 500 billion to replenish the seed capital for local infrastructure projects. And with some leverage, it could probably eventually turn into 2 to 5 trillion in terms of infrastructure investment over a multi-year construction period. And the next step is probably more, debt swap program, particularly this novel type of debt swap where policymakers are tapping into policy bank loans to help local governments to repay some of their monies owed to the private enterprises, which is a big overhang on business sentiment and the local economy. So overall, on the outlook, we still believe that with these incremental easing measures, the downside is probably going to be protected, but we do not see a decisive reflation in the near term. Policy stance will remain defensive in nature. It will stabilize growth, but probably not reflate. So in our view, for China to really decisively or durably reflate, we need deeper structural reforms, and this is probably the key to watch in the upcoming, fourth plenum and the 5-year plan to be previewed in this late October, because the current, institutional setup for China is that it rewards production. For example, if you look at the left-hand side chart, we see that the local governments are basically competing against each other in terms of GDP growth and tax revenue collection. And also China's tax system, which is indirect in nature, also rewards production because, this value-added tax, which is a big share of the tax revenue, as long as you produce, you can collect this tax revenue. And finally, to basically close the loop, the high saving rates in China, particularly among households due to weak social safety net, funds all these investment opportunities. But this type of a supply-centric framework is probably seeing diminishing returns, and that's why we think structural reforms are very much needed to rebalance the economy towards consumption. But of course, these are all very deep structural reforms, and none of them are easy. We see that basically a relatively more consensus have been forming around the so-called unification of the urban and rural social welfare system. Because right now, there's a big divide between urban and rural residents in terms of pension protection, in terms of medical care coverage. And that's where we think that the Beijing can focus on in the next 5 years. For example, in terms of the rural pension payout, to increase their monthly payout from currently just $30 a month to around 150, which is a more decent level. In our view, if they do that over the next 5 years, it could lift the consumption share in China by additional 1.5% percentage point by 2030. So that means the overall consumption share in GDP can rise from the current around 40% to 45%, because naturally the consumption share should rise amid population aging, but the social welfare reform can provide another boost to this rebalancing progress. But overall, these structural reforms are probably going to be very gradual. There are a lot of implementation difficulties. So we think this rebalancing progress will basically take place at a calibrated pace, and the economy will gradually shift from deflation to lowflation, but it's probably not a decisive reflation as we saw 10 years ago. So from now onwards, the key watch points, of course, is the late October 4th plenum. They will talk about this 5-year plan, and they will announce a communique and a central government guidance on how to make this five-year plan, which will be released next March. But we think the tone and the prioritization of different reform initiative matters, so it's still worth watching for in October. But overall, we think that, as I mentioned, all these structural reforms are going to be difficult. There's probably not going to be quick fixes along these structural imbalances, but things are moving in the right direction. And if they are incrementally more focusing on these rebalancing initiatives in the October plenum, we do think it can contribute to the ongoing constructive narrative surrounding China investment in China. That's it. I'll hand it back to you, Crystal. Thank you.
Thank you very much, Zhipeng. Now we are moving on to the Q&A session. The first one is for Rajiv. So as the US government shutdown begins, how much impact do you forecast on the US economy, and which set of data release will be impacted? Rajiv, I think you're on mute. Maybe I think he's still adjusting the audio. So I would just ask the question for Chetan first. As the US slowdown kicks in, which set of economies have better chances to deliver better growth? And India supposedly is a domestic play, but growth has seemed to be very subdued.
Yeah, so I think from a framework perspective, what we've been saying is that the ones in the region which are more trade oriented, and those are particularly the mid to small size economies, are the ones which are more affected. But on a relative basis, we think that India and to some extent even China is going to do better. China, because China has already demonstrated in the past, as well as they're doing it now, that their dependence on US has reduced, whereas the non-US markets have been taking greater share of China's exports. And then we are expecting this counter-cyclical policy support coming up from October. Whereas in India's case, yes, right now they have been going through, as I was mentioning earlier, in the context of youth unemployment, that there had been idiosyncratic reasons why India had gone through a domestic slowdown, primarily fiscal and monetary policy tightening. Both of them have reversed quite meaningfully. We saw that the government has done household income tax cuts. RBI then had cut interest rates, which is cumulatively about 115 basis points, 100 basis points on headline, and then interbank liquidity improving has added another 15 basis points. And then they've just done the goods and services tax reduction. And what the high frequency data points like auto sales, credit card spend is showing us is that there has been a sharp rebound since September 22nd when goods and services tax cut became effective. So I think all the three policies actions are coming together, and from fourth quarter itself, we should see a meaningful improvement in India's domestic demand story. So we still think that India will be able to do better in an environment where the U.S. exports to the U.S. slows down for the region and global trade slows down.
Thank you. That's clear. Thank you, Chetan. Rajiv, just checking whether you're on. All right. So there is a question for Jonathan. What catalysts are you watching that may trigger a downside rating for the equity markets?
Sure. I'd like to refer to some interesting work done by our colleagues, Serena Tang and Vishy Tirupata, around cross-asset correlations. So what they've been highlighting is that once we get into the Fed cut cycle in a serious manner, around about the time of the fourth cut, which would be upcoming in October, if we get it, you tend to get a change in the pattern of correlations. You tend to find that equities do less well and bonds really start to move. In other words, people move towards the safe asset. And so I think it really could be relatively soon that we see this taking place, so long as the global macro data continues to be characterized by weak fundamental growth and a broadly sort of stagflationary environment, but with clearly policymakers responding more to the weakness in real growth. And so, I think we could be there relatively soon, given the extreme nature of the price action we're seeing currently.
Thank you, Jonathan. There are several questions on China as well for Zhipeng. What is have you seen any progress updates on the anti-involution campaign? And just how you mentioned there is a slowing domestic demand, what data points are you tracking? And then the final question will be, will PBOC easing a easier monetary policy further in the fourth quarter?
Thanks, Crystal. So a lot of questions, good questions. First on anti-involution, our house view on this, the implementation has been very clear and firm, is that we think this time around is something different from 10 years ago, in the sense that the implementation will be more market-oriented, will be less of a administrative top-down mandate kind of approach as we saw 10 years ago. So right now, the progress has been focused on the upstream sectors because they have a relatively mature playbook from 10 years ago, and they are consolidating modestly, cutting production or even phasing out some outdated capacity in certain sectors. But right now, it's probably, all these measures are relatively measured and modest. It's not an aggressive cut, even in upstream sectors. And for the downstream sectors, I think which is facing, relatively, more overcapacity issues compared with 10 years ago, the implementation will be even more difficult because the products that the downstream sectors sell are differentiated. So it's even more difficult to coordinate. So right now, we think the policymakers are basically trying to enforce tighter regulations, through this lawmaking, such as price laws and antitrust laws, to define and, for example, rename this credit repricing. So this type of institutional approach is being implemented so that this involuted behavior in the downstream sectors are being, modestly rectified as we speak. But nothing, similar to the administrative type of approach like 10 years ago. So the outcome or the, effect of this anti-involution campaign. So in July and August, we see these commodity prices rising on a broad base. But coming into September, because the downstream demand remains relatively challenged, we see that even for the upstream sector price recovery, it has become less mixed and more divergent. And for the downstream sector, the pricing remains relatively subdued. So that's basically in line with our base case for the anti-involution, is that without a strong demand side stimulus, the effect and the implementation of this anti-involution will be quite gradual. And then second question on the PBOC, we think that there's a chance that the PBOC can cut modestly in the fourth quarter, especially if this domestic demand continues to cool. But I think by and large, the PBOC faces a dilemma in the sense that, of course, it faces some constraint regarding, the banking sector health, for example, the narrowing net interest margin among banks. But it also faces another constraint coming from basically a very distorted kind of interest rate transmission, because if it cuts policy rate, what could happen is that some local governments will force the local banks to extend very low interest loans to some local companies which should be facing higher interest rate. So that kind of a distortionary interest rate transmission also prevents PBOC from cutting rate more aggressively. So our base view is that if the economy continues to slow, and if this stock market does not show signs of overheating, then PBOC could cut modestly in the fourth quarter, for example, 10 to 15 bips. But there's also a decent chance that PBOC will not do that in the fourth quarter, particularly when the stock market is doing relatively okay. Finally, on data, in terms of domestic demand slowdown, we look at the monthly activity data published by the MBS in terms of retail sales, investment, and industrial production. And of course, besides that, we also look at high-frequency data in terms of housing sales. And just 2 days ago, the PMI data also shows that the service sector is not doing that well. So all these data are unanimously pointing to relatively weak domestic demand in the last 2 to 3 months. Yeah.
That's very clear. Thank you, Zhipeng. And lastly, back to you, Rajiv. Just checking whether we can hear you now.
Third time lucky. Can you hear me now?
Yes, we can. Thank you. So just want to get your thoughts on the U.S. government shutdown. How much impact do you expect for the economy, and then which set of data do you think will be impacted, including payrolls, for example?
Yes. So basically, there's a distinguishment between partial shutdowns and full shutdowns. This appears to be a full shutdown, and the implication is that Bureau of Labor Statistics will not be operating. In fact, Bureau of Labor Statistics put a notice on their website that non-farm payrolls would not be released if the government wasn't shut down. So the base case is non-farm payrolls, CPI, retail sales, basically most U.S. hard data will not be released during this time. Not a strong view on how long this will last. As you can see in the headlines, there's a lot of back and forth. The Democratic Party has really focused on healthcare and some of the spending cuts on healthcare in this government shutdown. But I think there's a broader debate around kind of fiscal expenditure that's going on. The general rule of thumb that we use is that for every week that we're in a shutdown, it's about 10 basis points. I think, it's really hard to handicap what the full effect will be in the U.S. And to bring it back to the conversation we were having earlier, given that we expect some of the risks in Q4 to start showing more firmly from the tariffs, the uncertainty is something that may weigh on markets. We saw, ADP, which is not always super correlated to NFP, decline. And so if that's the only signal the market has for now, that already gives you a sense of the risks that we have not having NFP data, for example. So not a lot of specifics, but hopefully that directionally helps you understand where things are going with the government shutdown.
That's super helpful. Thank you so much, Rajiv, and thank you, everyone. Thank you all the speakers for joining today. In the interest of time, we'll conclude today's podcast here and answer the remaining questions offline. Thank you so much for joining us, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.